My name is Paul Lindsey of MacMillan Estate Planning. Thank you so much for joining us today. We're going to cover off some of the principal topics that our clients seem to be interested in when they embark upon their estate planning journey.
What is the best way to succeed my family business when I retire?
So the main thing is that you have a plan. Having a good, solid business succession plan is only going to benefit you, your family, and of course your business. What most people tend to do is they bring in the new generation to succeed from you over a period of time. And by doing so, having that smooth transition means that the day-to-day management of the business remains unaffected. Now, of course, let's compare that to the business owner who decides that they want to retire next month. They rush through a business plan or a business succession plan. I can tell you from experience, the outcome is very, very different in each of those situations. When we're succeeding our business, we also have the opportunity to do some prudent tax planning to the extent that we can make clear the value of your business that will be subject to tax through your estate. We can mitigate income taxes, we can defer tax on the growth in the value of your business into the next generation, all while allowing you to retain as much or as little control as you'd like to have.
I have used up all of my TFSA and RRSP contribution room. Are there any other tax planning opportunities that I should be considering?
So when we have clients tell us that they've already used all of their TFSA and RSP room, we will often look to suggest that they may take advantage of what is known as the maximum tax range. This is something that allows you to make regular ongoing contributions and will allow you to shelter up to 25% of your net worth. What this means is that that value is able to grow tax-free in your lifetime and then move to your beneficiaries tax-free when you die. The way that it works is we're contributing over a period of time, so it's a little bit like a giant tax-free savings account. For many of the clients we work with, that is enough, the ability to tax shelter value. But for others, they look to optimize the strategy even further. This is done such that they can generate additional investment growth in their estate and at the same time reduce their annual income tax liability.
I want to pass my business to my children after my death, but I am worried that the tax liability will mean that they will have to sell it.
So if you don't plan, this could very well be the case. When we die, Canada Revenue will be coming at our estate from all sorts of different angles. First off, our estate will have to pay capital gains tax on any increase in value in the business from the date that we started right the way through to the date that we pass. And if that wasn't bad enough, then our beneficiaries are faced with a situation where there is value remaining in the business. How do they release that value? Well, the answer is typically they're going to have to declare a dividend from the company. And again, that is taxable income. The net effect is that our business could be paying tax at a rate of 66%, which quite frankly is eye-watering. But there are some strategies that we can use to mitigate that tax charge. We could look to implement an estate freeze, which is a way of crystallizing or freezing the value of our business that will be subject to tax. It will allow us to reduce our annual income tax, and it will allow us to also defer tax on the growth in the value of the business to the next and subsequent generations. Then we have what is known as the lifetime capital gains tax exemption. And this means that if our business becomes what is known as a qualifying business for tax purposes, we or our estate can utilize up to $1.25 million of tax-free growth in that business. Then finally, we can use a tax sheltering opportunity that will essentially remove that layer of taxation that our beneficiaries will ordinarily have to bear if they were to take a dividend from the company to release trapped value.
I have a family cabin that I want my family to retain after I pass away. Can I just leave it to them in my will?
Well, you most certainly can, but usually the most appropriate way to deal with this situation would be to use a family trust. This is a trust that we create in our lifetime. we are able to transfer the cabin and often a sum of money or an investment account into the trust. The idea is that those cash assets can be used to meet ongoing sundry expenses, maintenance costs, things of that nature. But the beauty of this structure is that the trust is separate from the personal assets of the beneficiaries. So it means that if we want the cabin to remain in our family for generations to come, we can do that without having to worry about a granddaughter or a son going through a divorce or having some sort of creditor or other third-party claim, because the trust is separate, and so those claims will have no call on the value of the assets inside the trust. In essence, the way the trust works is it puts a fence around the assets that it holds. Now, beyond that, we have the ability within the trust to write the rules, or what we call the governance, as to how you would like that trust to be administered both in the here and now and also into the future.
If I have a will, then I don't need to probate when I die?
Having a will doesn't avoid probate. In fact, probating a will is the process whereby we go to the court and ask them to confirm that the will we have is valid. Now, probate can be a time-consuming and costly process, and so for many, there really is a desire to avoid it. And this can be done through the use of strategies such as trust planning or even appropriate investment portfolio modelling, such that the value of the investments don't have to be probated when we die. Now, of course, if you live in a province that charges probate fees, there is often a real concerted effort in that scenario to do whatever we can to avoid probate. Because in those provinces, you could be losing a percentage of your estate purely to that punitive fee.
I am worried about stock market volatility and how this could impact my retirement.
The last thing that we want when we're coming up on retirement is to be concerned about market volatility or that the value of our retirement fund isn't what it once was. We are able to offer a strategy here to provide you with that peace of mind that when you come to retire, your funds are going to be there for you. The way that we do this is we use a particular style of investing that offers an investment guarantee. This means that if, for example, I'm going to retire in 15 years' time, I will know that the value of my pension fund, together with deposits and growth, will be there for me when I retire.
I have built a sizable estate, but I worry that my children will waste it when I die.
This is a really common concern amongst many of the families that we work with. The reality is you've spent too much time, you've made sacrifices to build the estate that you now have. Often the children don't quite realise that, and so as part of the estate planning process, we like to try and educate them so that they can understand exactly how the wealth has been built, as well as what your philosophy is around wealth management and wealth preservation. Now, of course, if that doesn't work, there are strategies such as trust planning that we can implement if you have concerns that when your children inherit, they will head straight to the Ferrari garage and potentially waste away their inheritance. Beyond that, some families will even build incentives into their trusts so that, for example, and traditionally these incentives are tied to milestones such as employment or education, but the theory is that these families take the view that if the child gets a good education, if they get meaningful employment, well, of course, the trust fund will be there to support them and for them to benefit from. However, if they decide to do nothing or make very little of their lives, well, in that instance, they will not just be able to rely on that trust fund. We also have to bear in mind that when children receive an inheritance through a trust, it preserves that value. It allows you to keep it in that bloodline. The trust is separate from your child's individual assets, and so if they are ever facing a third-party claim, such as a divorce, somebody suing them, or a problem with a creditor, you know that your inheritance isn't leaving with any of those third parties. It is protected and preserved for your child.
I have a large registered account that has built up over time, but I am not reliant upon it for my retirement income. What should I do to keep taxation to a minimum?
A registered account can become a real tax burden if it isn't managed correctly. Of course, when we're building up these accounts, we can view them positively because we're benefiting from tax-deferred growth. We get an income tax deduction that we can utilise annually. But what happens when we move towards retirement? Well, all of a sudden, our registered accounts could well be a source of income that we don't really need. Now, when those registered accounts turn into RIFs, we are being forced to take income that, again, as I say, could be income we don't need, but it's also going to be taxable. It could very much be the difference between tax brackets. Beyond that, when we pass away, and particularly for many of the families that we work with that have sizable registered accounts, the remaining balance is added to their income in the year of death. And so what that can mean, more often than not, is that they become a higher rate taxpayer, and so 48% of the value of the registered account is being lost to taxation. We have a particular strategy where we can steadily unwind these registered accounts so that we are able to mitigate taxation in your lifetime and equally when you pass away.
I have a property in British Columbia and another outside of Canada. What impact does this have on my planning?
So, of course, there are two components to this question. The first one is the provincial aspect. Now, if we do hold property in British Columbia, we have to be mindful of the impact of probate fees. In essence, in BC, for every $1 million of value that you hold, your estate will be paying a fee in the order of $14,000 to $15,000. So it isn't a small amount that's at stake here. Now, if we want to avoid that fee, what we can do is we can utilise lifetime trust arrangements, investment portfolio modelling that doesn't need to be probated, or even the use of a private will. Then, of course, if we're looking at holding an asset outside of Canada, again, there are two subdivisions to consider. The first one is taxation. How will Canada Revenue view taxation on this particular foreign asset? Equally, how will the local jurisdiction view taxation on the asset? On the flip side of that coin, when we're talking about succession, well, how is that going to go through our estate from a domestic perspective and then again from a local perspective? In some jurisdictions, of course, we're dealing with things like forced heirship, for example. Now, some of the strategies that we've commonly utilised will include the use of perhaps a Canadian company or trust to hold the asset, because what that does is it allows for maximum tax and equally administrative efficiency through our estate.
How is my estate taxed when I die? Will I have to pay estate tax?
In Canada, there is no estate tax or inheritance tax. What happens is that when you die, Canada Revenue will be looking to your estate to pay tax on the value of any gains in relation to the assets within the estate. So that could be an increase in value of a piece of real estate, investments, company shares, or even your personal effects. In addition, your estate will have to deal with your income taxes. So in the year of death, your estate will be paying tax on investment income, Canada pension, personal pension arrangements, as well, of course, as the value of any outstanding registered accounts, which will be added to your income. Now, from an estate planning perspective, it's worth understanding that there are a number of tax planning, tax mitigation strategies available. Through the process of planning, we look to educate, we look to analyse and determine which strategies fit well into your estate, and of course which will mitigate the overall tax that your estate will bear. Thank you again for joining us today. I hope that the information that we've provided has been useful, but of course, if you'd like to learn more, please do feel free to register for one of our seminars or webinars, or indeed to schedule a consultation with me or one of my colleagues to talk through your specific requirements in a little bit more detail.